Good afternoon and welcome to today's Employment Taxes webinar for not-for-profits and government. I'm Stephen O'Flynn, a Tax Director at SW, and I'll be moderating today's session. It's great to have so many of you on the webinar today. Firstly, I acknowledge the traditional custodians throughout Australia and their connection to land, sea and community, and we pay our respects to their elders past and present and emerging. I'll present on what is new in employment taxes. Presenting today with me will be Rahul Sangani, Senior Manager in our Employment Taxes team, who will provide you with an FBT recap of key considerations for the major fringe benefits. Tony Principe, an Associate Tax Director, will be presenting on the recent High Court cases related to the employee versus contractor distinction that have been quite controversial lately. Justin Petticciotto is an Associate Director in our Employment Taxes team who has particular expertise in expat taxes and employee share schemes. Will be presenting on residency issues. Today's presentation will run for an hour and conclude at 3 p.m. Just with some further housekeeping, before we start, I'd like to run through some of the housekeeping with you. Whilst we're presenting, you can raise your questions throughout the Q&A function. The Q&A button can be found at the bottom of the screen. Please feel free to send questions throughout the session using this function. We will endeavour to answer your questions throughout the presentation, and if time permits, we'll try to answer some at the end of the session. We'll also be circulating the slides to everyone who attends after the webinar concludes. Okay. We always include the relevant tax rates and thresholds for 21-22 so that you have an easy point of reference. Probably the main ones to look out for here is the cents per kilometre for cars. It didn't actually move from 2021 to 2022, but it's interesting where this will land next year considering the big increase in fuel prices at the moment. Also, one of the key rates to consider is that the daily rate for car parking is $9.25. This is important because if there is no commercial car parks within a 1 kilometre radius of where the employee car is parked, then they will not be provided with a fringe car parking fringe benefit. Okay, so what's new? Last year, the Commission provided their view on the tax gap that occurs that relates to FBT. They identified a FBT gap of $1 billion. Whilst there has not been specific FBT audits carried out for a number of years by the ATO, they still undertake FBT reviews as part of their broader reviews of clients or audits, and they are also doing a lot of data matching of motor vehicle information. In August 2021, the ATO released a ruling providing further guidance on the distance an employee must travel for overnight business travel. The ruling provided further guidance such as an overnight stay is a mandatory requirement for deductible accommodation, food and drink expenses. Family accompaniment does not default to a conclusion that the person is living in a location, so your family can still travel with you and you can receive a travel allowance. There is also a potential reset of the 21-day count where an employee travels to other work locations or travels back home, but we'll cover this on the next slide. TR 2021/1 confirmed the long-standing principles such as transport expenses incurred for ordinary travel between home and a regular place of work are not deductible, and transport expenses incurred by an employee travelling between work locations are generally deductible, and also travelling from home to a secondary work location, which is not your regular work location, is also deductible. The following factors were provided as supporting the characterisation of transport expenses as being incurred in gaining or producing assessable income and income tax deductible. The obligation to incur transport expenses arises out of the employment itself and not the employee's personal circumstances. The transport expenses are a necessary consequence of the employee's income producing activity. Due to COVID, we've seen a change in working arrangements where a lot of people are working from home. It surprised us that this was not factored into the ruling. A couple of questions that you might think of is, what if an employer's contract is silent on where their regular work location is? Or what if the employment contract states the person's regular work location is their home? It'll be interesting to see if in these circumstances, if someone will successfully argue that travel to the employer's office will be in the nature of travel on work, considering their primary place of employment is at home. We've also had a recent announcement, PCG 2021/3, that provides a practical approach to assist taxpayers in complying with relevant tax laws. If you follow this guideline in good faith, the Commissioner will administer the law in accordance with this approach. It is not necessarily a bright line test. The PCG makes it clear that the ATO will accept that where an employee is away for less than 21 days at a time, they'll be considered to be travelling on work. This is important for employers as the daily travel allowances are greater than the living away from home allowance. And provided that you expect your employee to spend all the travel allowance you pay them on accommodation, food, drinks, or incidental expenses, then they are not required to withhold from a travel allowance. The 21-day limit can be extended where an employee travels to multiple locations. So in this example on the screen, we have an employee traveling from home, then they go to Hobart, then to Hobart for 14 days, then from Canberra to 20 days, and then back home on a cyclical sort of a basis. But then at the end of the period, after 3 trips, they stay back in home. They're in Hobart and Canberra for 34 days. So that exceeds the 21-day limit, but the 21-day limit is not breached because there's only 14 days in Hobart and 20 days in Canberra in those particular trips. So the 21-day clock is reset. The ATO accepts that a person can travel to a single location for up to 90 days in FBT year and still be considered to be travelling on work. This is, of course, subject to the 21-day individual limit. So as you can see in this timeline that we've created, the employee is never in the one place for more than 21 days in one stint and has travelled for less than 90 days to both Hobart and Canberra individually. Therefore, whilst they have travelled for 102 days, as neither of these tests have failed, the employee can be paid a travel allowance for each day of their travel. If you do not meet this criteria, it does not mean that you are not travelling on work. As we said before, it's not a bright line test. However, the ATO is more likely to look into the arrangement, and employers should consider more closely whether or not the employee is actually travelling or living away from home, and potentially apply for a ruling for clarity. We've actually had situations where we've obtained rulings where people have travelled for up to 90 days to one location, and the ATO have accepted that they are travelling and eligible for a travel allowance. There's also been a fact sheet for employers titled COVID-19 Vaccination, Incentives and Rewards, Your Tax and Super Obligation. This fact sheet outlines the tax and superannuation consequences an employer needs to consider when incentives or rewards are provided to employees to get COVID-19 vaccinations. In particular, if you provide staff with cash payments or paid leave, unfortunately, they're going to be subject to PAYG and super. However, if the employer provides or pays for transport to get vaccinated, this would be FBT exempt, as it is considered to be travel associated with work-related preventative healthcare. The FBT status of other benefits, such as goods and services or gift cards or points, will depend upon the ordinary FBT rules. You may be able to access the minor and frequent benefit exemption or the in-house fringe benefit reduction for them. There has been confusion regarding the deductibility of rapid antigen tests. The Prime Minister told the media that RATs would be tax deductible. At the time, this was somewhat confusing as there was only limited circumstances in which RAT tests will be a legitimate working expense for tax purposes. On 8 February 2022, the Assistant Treasurer released a press release to confirm that work-related COVID-19 test expenses incurred by individuals will be tax deductible from 1 July 2021. provided that the employee is not reimbursed by the employer. So it's important there that we're talking about work-related COVID-19 tests. As the legislation has not been introduced, clarity is still required to understand what work-related COVID-19 test expenses incurred by individuals means. We assume that an individual taxpayer may only qualify for tax deduction for a RAT where they're required to take a test before undertaking work. For example, as a mandatory requirement under an employer COVID mandate, or where they're required to travel for work and the RAT is required under a state direction or health order. In addition, employers will not be subject to FBT where they provide COVID-19 testing to their employees for work-related purposes. As a result of COVID, employers have provided employees with a lot of benefits, in particular while they're working at home. The ATO released a fact sheet that highlighted how to deal with the benefits provided to employees that are working from home. Unfortunately, the fact sheet merely applies the existing FBT rules to the COVID environment, and while some minor substantiation concessions have been made, the rules remain particularly complex for office equipment and furniture. Firstly, it covers eligible work-related items that are exempt from FBT, which includes items primarily for use in the employee's employment. For employers that are not small businesses, they cannot provide employers with two similar items in the same year. An eligible work-related item includes a laptop or mobile device and tools of trade. Office equipment such as a dual screen or docking station are not eligible for the eligible work-related item exemption. They can fall into three categories. They could be a temporary arrangement where the equipment is intended to be returned to the office, in which case it's been accepted that would be exempt from FBT. If it's a permanent arrangement where the equipment is to be retained by the employee, it will not be exempt from FBT, but may be eligible for either the otherwise deductible reduction, where the employer has a policy that equipment can only be used for work purposes. The no private use declaration can be made to reduce the taxable value to nil, where the employer has a policy that the employee has agreed through written confirmation that the items are only provided to enable your employer to perform their duties at home, and the items remain the property of your business. In these situations, the ATO sort of accepts that some sort of minor incidental use at home is okay. The third type of category is where there is a gift of the office equipment or the employer reimburses staff for their expenditure. In this situation, you may be able to access a 300 minor and infrequent benefit exemption. We've seen the large number of employees' well-being has been impacted by COVID, so employers should not forget the exemptions for work-related counselling and work-related preventative health care. It is important to remember that for work-related preventative health care, that this includes any form of care that is provided by or on behalf of a legally qualified medical practitioner, nurse, dentist, or optometrist for the principal purpose of preventing injury or disease related to the employment. Now we thought we'd launch our first poll. How has COVID made dealing with your fringe benefit tax? Has it become easier, primarily because you don't provide as many benefits? Harder, as you have to deal with the extra benefits being provided as a result of COVID, or about the same, or unsure? We'll leave that open whilst I continue on. There was also a recent exposure draft legislation released. It's pretty much a minor technical amendment, and it was introduced to replace the concept of rebatable employer in the case where an FBT exemption is provided to employees by an employer that is a society or association carrying on a private hospital. And this is from the 2017 to 18 and later income years. So it's pretty minor, it won't affect too many people, but if you're a not-for-profit carrying on a private hospital, it's probably just clarifying what the existing rules already state. Yeah, whilst most not-for-profits are not subject to car parking fringe benefits, government is subject to FBT on car parking, so we've included the Virgin case here. So the recent Virgin case related to whether a car parking benefit arose on a particular day, the key issues to be considered being, on that day, did the employee have a primary place of employment? And during that day, is the car parked at or in the vicinity of that primary place of employment? Virgin argued that either the aircrew's primary place of employment was an aircraft, so the aircrew were not parked within the vicinity of their workplace, or the aircrew worked on multiple aircraft during the course of the day. There was no primary place of employment. However, the full federal court allowed the Commissioner's appeal against the earlier decision by a single judge of the federal court and held that the primary place of employment for flight crew and cabin crew was each employee's home base, airport terminal in Sydney, Brisbane or Perth. The relevant parking facilities were provided in the vicinity of the relevant home base, so it followed that the car park was within a 1 kilometre radius of the home base and the car parking benefit was provided. I will now hand over to Rahul to run through the FBT recap of the main fringe benefits.
Thank you, Stephen. We'll now run through a refresher on the calculation of fringe benefits for most common benefits provided by employers. For not-for-profit employers, FBT rules allow some important concessions in the form of rebates and exemptions, subject to certain capping thresholds. There is an exemption cap of $30,000 and $17,000 that applies to public benevolent institutions and public hospitals, and a $30,000 rebate cap for registered charities. In addition, there is a separate $5,000 cap for meal entertainment benefits that are salary sacrificed. Car parking benefits provided by certain not-for-profit employers is also exempt from FBT. This includes car parking expense payment benefit too. And lastly, an extended definition of remote applies to housing benefits provided for employees of certain not-for-profit employers. This means that more areas will be considered remote for such employers. Here is a table summarizing the various caps. Next benefit we'll cover is cars. Cars are the most important benefit that employers provide to their employees. A vehicle will be considered a car for FBT purposes if it satisfies certain conditions. It must be a vehicle designed to carry a load of less than 1 ton and fewer than 9 occupants. If this does not, it does not include a vehicle that is principally designed to carry goods, for example, single cab vehicles. It is important to consider the carrying capacity of a vehicle to decide whether it's a car for FBT purposes. For example, some dual cab vehicles would be considered cars if they are designed to carry a load of less than 1 ton. The advantage of a vehicle being considered a car is that the rules allow the use of stat formula method in calculating its taxable value. Where a vehicle is not considered a car, it will be considered a residual benefit. You can calculate the taxable value of a car fringe benefit using either the stat formula method or the operating cost method. The stat formula method is simple to use and provides a good outcome when the business use of the vehicle is not high. Under this method, the taxable value of the car benefit is the statutory rate multiplied by the car's base value and reduced by any employee contributions. The base value of a car is the GST inclusive price plus the cost of any fitted non-business accessories and dealer delivery charges, but does not include registration and stamp duty paid. The operating cost method requires the employee to maintain a logbook and records of the operating costs, but gives you a better outcome if the business use is high. Under this method, the taxable value is worked out by multiplying the total operating costs of the car with the percentage of private use and reducing the result by any employee contributions. Operating costs include both actual and deemed costs, such as depreciation and interest. The private use of the car is worked out from the logbook maintained by an employee. It is important to remember that a logbook is valid for 5 years, after which the employee must re-estimate their business use. Vehicles that don't qualify as a car are taxed as residual benefits. The benefit of such vehicles is that home to work travel is considered business related, where other private use is limited to minor, infrequent, and irregular, and no FPT is payable. The ATO had released a practical compliance guide in 2018, setting out circumstances in which they will generally accept that certain vehicles, when used privately by employees, may be exempt from FPT. The use of this practical compliance guide is limited to vehicles that satisfy certain conditions. The vehicle should not be provided to the employee under a salary packaging arrangement, and it should be provided in relation to the work of the employee, i.e. for business use. The GST inclusive value should be less than the luxury car threshold at the time of acquisition. The employer should have a policy to limit private use and obtain assurance that the vehicle's use is limited to travel between an employee's home and work, and any diversion adds no more than 2 kilometers to the ordinary length of that trip. Journeys undertaken wholly for private purposes during the year should not exceed 1,000 kilometers in total, and any return journey does not exceed more than 200 kilometers. So if the employee was to use the vehicle to move his house during the year and that journey was no more than 200 kilometers, it would qualify. We recommend that if you have exempt vehicles, you should consider if you are eligible to apply this practical compliance approach. We have been getting a few COVID questions from clients in the last 12 to 24 months around the use of cars and FPT. We have listed some questions here. The first question was around cars garaged at an employee's house during COVID lockdown. Generally, where an employee is garaging a work car at home, the starting position is that the employer may be providing them with the car fringe benefit. The ATO has, however, released a fact sheet for employers who find themselves in this situation, where according to the fact sheet, where the statutory formula method is used, FPT will be payable on such cars. However, where the operating cost method is used and the car is not being driven at all or being driven for maintenance purposes only, the ATO deems that the car is not being held for the provision of a fringe benefit. Second question is around logbooks. So the ATO has stated that where employers use the operating cost method, they may choose to continue using that logbook to make a reasonable estimate of the business kilometers traveled during the year. Employers can also elect to keep a new logbook, which is representative of the business kilometers traveled during the year. Next question was around logbooks again. This question was, can we start a new logbook prior to the end of the FPT year? The answer is yes, you can, provided the logbook is started before the end of the FPT year, and you can use the logbook percentage from that new logbook in your operating cost calculations. Next was around declarations. Can we get declarations instead of can we get a no private use declarations instead of relying on logbooks? The answer is yes, you can, but you will still need some evidence like odometer readings or service records to support the declaration. Next benefit type is car parking. So before we get into car parking benefits, it's worth mentioning that car parking benefits are not subject to FPT and it is not included in the capping thresholds when provided by not-for-profit employers. This includes a car parking expense fringe benefit as well. Examples of not-for-profit employers are registered charities, scientific institutions, or a university. A car parking fringe benefit arises only if all the following conditions are satisfied. The car is parked at the premises owned or leased by the provider. It is parked in the vicinity of the primary place of employment. This was an issue that was discussed in the Virgin case. The car has to be parked for more than 4 hours between 7 a.m. and 7 p.m. and should be used on the day to travel between home and work. And lastly, and the most important, there should be a commercial car parking station available within a 1 kilometer radius of where the car is parked that charges more than the daily rate threshold for the year. So for this year, the rate threshold is $9.25. So if a car parking station charges more than $9.25, you have a commercial car parking that is going to qualify you for car parking fringe benefits. Something to note here is that car parking fringe benefits arises in relation to cars and not exempt vehicles such as utes. So if you've got a ute, which is not a car, but a vehicle other than car and is parked on a car parking spot, you should not have any car parking fringe benefit. There are two parts to calculating the taxable value of car parking fringe benefits. In the first part, we calculate the value of the benefit where we have the choice of 3 methods. Under the commercial car parking station method, it is the lowest fee charged for an all-day parking by any commercial parking station within a 1 kilometer radius of the premises. Where all-day parking fees are paid on a weekly or a monthly basis, you can determine the equivalent daily rate by dividing the total fee by the number of business days in the period. Under the market value method, you must obtain a valuation report from a suitably qualified valuer to decide the market value of the parking spot. One benefit under this method is that the valuer, while working out the value of the parking spot, generally strips out any taxes. For example, a $15 Wilson's or a secure parking daily rate will have City of Melbourne car parking levy built into it. When a valuer values the same spot, his rate will be lower as the car parking levy is not included in his calculation. Under the average cost method, you calculate the average of the lowest fee for the first day and the last relevant day of the FPT year. Once the value is determined, you have 3 choices for calculating the taxable value. Under the 12-week register method, you work out the number of times car parking benefits are provided in a 12-week period and use that ratio to calculate the number of times the benefit is provided during the FPT year. Like cars, under the operating cost method, the register is valid for 5 years. The stat formula method deems that a car parking benefit is provided for 228 days for each car parking space. Under the actual method, the benefit is worked out on the basis of actual number of days the car parking benefit is provided. For small business employers, car parking benefits provided to employees will not be subject to FPT if certain conditions are satisfied. The ATO had issued a ruling last year in relation to what constitute a commercial parking station. The ATO has expanded its view in the ruling that certain paid car parks that were previously excluded from commercial parking stations in tax ruling 1996/26 may now be captured as commercial car parking facilities. The ATO has said that where a parking facility is run by a car parking operator, the facility is a commercial car parking facility for FPT purposes. If, however, the car parking facility is not run by a car parking operator like Wilson's or Secure, the ruling provides three characteristics to decide if the car parking facility is a commercial parking facility. The first test is whether the facility has clear signage that is visible from the street. The facility has a mechanism to control who enters and exits, example, a boom gate, and the facility charges more than a nominal fee for parking. If the car parking facility displays two or more of the above characteristics, the commissioner has decided that the facility is a commercial car parking facility for FPT purposes. Now, it is important to note that this change in the ATO's view on commercial car parking stations will apply from the FPT year starting 1 April 22, which is the next FPT year. We have been asked some questions in relation to COVID and car parking as well. The first question was, can the period to which the statutory formula apply be intermittent? While the law itself is not entirely clear based on the usage of the term availability periods in section 39 FA, when calculating the taxable value, our view is that the time during which the work car park is closed will not form part of the availability periods used to calculate the taxable value. Therefore, the period can be intermittent. Next question was, would parking for an essential worker be considered car parking benefit when all the commercial car parking stations in the area were closed? So if all the commercial car parking stations within a 1 kilometer radius of your business premises are closed on a particular day due to COVID, there should not be any car parking fringe benefit. Last question was around the fee charged being less than the threshold for the year. So if on 1st April 21, the lowest fee charged by all commercial parking stations within a 1 kilometer radius of your business premises was less than $9.25, you will not have a car parking benefit for that year. For example, this may occur when all the commercial parking stations have discounted their all-day parking rate due to COVID-19. However, if this rate is reduced, if the reduced rate is less than the average of the lowest fee charged by any commercial car parking station within a 1 kilometer radius 4 weeks prior or after 1 April 2021, which is the start of the FPT year, the reduced fee is ignored and you will have a car parking fringe benefit for that year. Next, we discuss entertainment. We'll not go into details with entertainment benefits, as most of the alcohol we consumed in the last 12 months was to sanitize our hands. So very high level summary, entertainment fringe benefits arises where food, drink, or recreation has been provided to employees. It also includes accommodation or travel in connection with entertainment. However, there are instances where food and drink provided to employees may not constitute entertainment for FPT purposes. For example, if it's sustenance like tea, coffee, or biscuits, they should not constitute as entertainment. Meals whilst traveling, they are considered otherwise deductible, hence not subject to FPT. Light meals under $15, for example, a coffee and a sandwich, should not be considered entertainment. Entertainment provided around CPD courses or seminars, provided that CPD course or a seminar is for more than 4 hours, the entertainment should not be considered subject to FPT. And lastly, if you got entertainment provided in a corporate box, the commissioner has accepted that 5% of the amount spent on the corporate box would be attributable to advertising and hence not subject to entertainment fringe benefits. Just a quick recap on the administration. Reminder to obtain declarations prior to the lodgement of the FPT return. This can be obtained electronically provided they are signed by the employee and should be kept on file for 5 years. These are important if you want to claim reduction under the otherwise deductible rule or certain other benefits, for example, LAFA. Not all benefits are reportable in an employee's payment summary. For example, car parking, use of shared cars, certain remote area benefits, and non-salary sacrifice meal entertainment benefits are not reportable even if their value exceeds $2,000. With the recent ATO guidances on travel, it is important to check that your travel policies are up to date with what the Commissioner considers business travel. And lastly, whilst tax savings should not be at the forefront of our planning, it is always good to consider whether it is financially a better outcome to pay an employee cash allowance subject to PAYG and super, or to provide them benefits subject to FPT at the top tax rate of 47%. Most of us use some form of software in preparing their FPT returns. Shining Australia has an easy-to-use FPT software for employers. This is an Excel-based software that can handle from basic to complex FPT returns. Please feel free to reach out to any of us if you need further information on this. Now I'll hand over to Tony, who will take us through recent updates on the employee versus contractors.
Thank you, Rahul. Before I start my session, we will run a further poll for purposes of determining what actions parties currently take in determining their classifications of employees versus contractors. We tend to find that a number of our clients perform the classification at the time the contractors are actually first engaged for the purposes of determining any compliance activities associated with them. The other thing I'll note, just as a reminder, we do have a Q&A facility available to you, which can be found as a button at the bottom of your screen. If you do have any questions that you would like to pose, we do have people ready to be able to answer those questions for you. Now, in respect of this particular topic in particular, I note that contractors form an integral part of our modern labour market. And in many cases, contractors are truly independent, and the determination of them as contractors rather than employees at times will be self-evident. But in many other cases, it's not always clear-cut. And the uncertainty arises both out of the application of common law principles as well as various statutory rules that apply. As a reminder, whenever you're looking at an arrangement with an individual as to whether they're an employee or contractor, you'll need to contemplate, are their payments subject to PAYG, superannuation guarantee? Is there potentially a payroll tax or workers' comp liability associated with the payment? Where benefits are provided, you need to consider, are they going to be subject to FBT if they're provided for employees rather than contractors? And is the payment subject to GST that's being made? Unfortunately, what we do find is that payments to contractors in the main are typically made outside of the normal payroll system. And at times, even though there may be an obligation associated with them, they're not automatically detected as part of preparing the relevant returns. So what has happened in this regard? Well, historically, at one point in time, the question as to whether or not somebody was an employee was very much a matter of whether or not there was a master servant arrangement in place. What then happened over time is the case law actually evolved, and it was based on a judgment of looking at a multifactorial approach. That is, the courts would look at the totality of a relationship to determine whether or not an individual was an employee or a contractor. However, this was at times not always that clear cut. The VABU cases highlight the difficulty that the courts had in distinguishing between employees and contractors. The first of the VABU related cases was a decision of the New South Wales Court of Appeal in VABU and the Federal Commissioner of Taxation. The matter of concern there was whether or not the couriers were employees for super guarantee purposes. The couriers in that instance were three types, being cars, motorcycles, and bicycles. The courts actually found in that instance that the couriers, including the bicycle couriers, were independent contractors and not employees. And an influential factor in that instance, when the court considered all the factors, was the fact that the couriers had to have substantial equipment, including those that were using bicycles. Now, it was only 5 years later in the full High Court that in the case of Hollis and Barbu, so this was a vicarious liability case, that the court found that the bicycle couriers were in fact employees of Barbu. It should be noted that in this particular case, the other types of couriers were not considered, but notwithstanding that, the court was still of the view that the factors of the arrangement between Barbu and the cyclists was such that the work practices were imposed by Barbu. They had to wear clothing with logos by Barbu. They were not providing labour which required any special skills or qualifications. And as a result, considering all the factors, the view was that they were actually employees. That same approach was adopted a few years later in the High Court decision of Boylan. In that instance, you had an independent contractor who went onto a site to perform a repair of a fridge. The repair was faulty and part of the equipment fell on an individual who then sued the owner of the premises. Once again, in that instance, the court looked at the various factors. They noted the contractor provided their own tools. They had multiple clients. They could delegate the work. And their view in conclusion was that that particular contractor was not an employee. That particular principle has now been moved on from. We've got now recent case law where the focus is primarily on the terms of the contract. It's only been in recent times, as an example in the Rosato decision, that involved an employee who was under a contract of casual employment and sought to recover their entitlements as if they were a full-time employee. They had regular shifts, and for all intents and purposes, they pretty much worked full-time over an extended period of time. It was common ground before the High Court that the expression casual employee, for the purposes of the Fair Works Act, which the employee was seeking to get compensation under, refers to an employee who has no firm advance commitment as to the duration of the employee's employment or the days or hours the employee will work. And so the outcome of the appeal rested on whether or not such commitment existed in respect of Mr. Rosato. The court concluded in this instance that notwithstanding the surrounding circumstances where you actually looked at the underlying contract, there was no enforceable expectation under the agreement that the employee would have a firm advance commitment. That is, the employer could at any stage cease the arrangement with no recompense from the employee. That same principle of the contract being of primary importance has been effectively reinstated in recent cases in the last month in ZG Operations Australia and JAMSEC, and in the CFMEU case. In the first instance, in the JAMSEC decision, you had two individuals who had been long-term employees of the organisation, and they were essentially the truck drivers for the organisation. The organisation then decided that they would no longer employ staff for the purpose of making deliveries and instead would subcontract that arrangement. So those two employees then entered into a contractual arrangement. They established partnerships with their wives. They purchased trucks and were required to maintain the trucks for the purposes of the contract. For all intents and purposes, they did exactly the same things as they did previously at the time that they were employees. But the court in that instance determined that notwithstanding the surrounding factors, the contract takes primacy, and the terms of the contracts were such that they were in the sense of an independent contractor, not employees. That same principle has been adopted in the case of personal contracting that involved a labour hire firm effectively hiring out a staff member to perform services on a contracting site. That particular individual performed labouring type activities, And in that instance, the court noted that the contract provided effectively for the individual to be regarded as being employee. The reasons primarily were that the contract provided that the labour hire firm would pay the individual. The labour hire firm under the contract retained the right of control of the individual's activities, and the labour hire firm was able to terminate the arrangement if the individual failed to obey the directions on site. In both instances, you've got circumstances where the courts have ruled on the basis of the underlying contract. So what does that mean for us on a go-forward basis? Essentially, moving forward through these decisions, the High Court has comprehensively held that to establish whether a person is an employee or independent contractor, it's necessary to give primacy to the legal rights and obligations contained in the contract entered into between those parties. So moving forward, it'll be important for organisations, employers and companies to review their written agreements with employees and independent contractors to ensure that contracts correctly affect the arrangement parties understood that they were entering into. The courts have also ruled in the recent cases that I've just gone through that the relationship and how it's labelled in the agreement. So even if the agreement says this is a contracting or this is an employment relationship, will not be decisive. It's rather the terms of the agreement that will be important. So in overall conclusion, the courts previously provided a multifactorial approach to assessing whether a worker was an employee or a contractor. The terms of the contract were relevant but weren't decisive. Many issues need to be considered, including how the relationship played out in practice. Now it's the case that where at least there's a valid contract in place that sets out all the terms of the parties' relationships, you focus exclusively on the rights and the obligations in the contract, rather than what happened in the working relationship. The decision does provide a greater degree of certainty in terms of organisations that have valid contracts in place. What it does also mean is that the multifactorial approach may still be relevant only if the contractual terms between the parties are unclear or have resulted from a sham arrangement or another breach of the law. On that note, I will hand across to Justin.
Thanks, Tony, and good afternoon, everyone. The next section that I'm going to walk us through is tax residency, and firstly, the proposed changes that were announced in the 2021 federal budget. It is important for both individuals as well as employers to understand the proposed changes and how it may impact the individual's tax implications, as well as the employer's reporting and withholding obligations. Tax residency status is important as for an individual, it will determine what tax rates apply, what income that individual needs to disclose in their individual tax return, what levies they're liable for, as well as what tax offsets they're eligible for. For an employer, it will assist in determining what reporting that employer needs to do, including pay-as-you-go reporting and withholding, FBT, superannuation, as well as payroll tax. So under the existing residency rules, there's firstly a primary test, and this determines whether an individual resides in Australia under ordinary concepts. If an individual is not deemed to reside in Australia under ordinary concepts, then we need to look at the 3 statutory tests. And those statutory tests are the domicile test, the 183-day test, as well as the Commonwealth Superannuation Fund test. Simply being present in Australia for less than 183 days does not automatically mean that an individual is a non-resident of Australia for tax purposes. So under the primary test or the ordinarily resides test, there's a number of key factors that we would look at that will help determine whether an individual is a tax resident of Australia or not. So some of the key factors that we would look at include their physical presence in Australia, their citizenship, where their family are residing, do they have a permanent home in Australia, or do they have permanent residence outside of Australia? Do they have employment ties in Australia? And where are the majority of their assets and social connections? You can see in this table why tax residency of an individual is very important. So this table really demonstrates the difference between being a resident of Australia for tax purposes and being a non-resident. So you can see that if you're a resident, you are eligible for the tax-free threshold, you are eligible for tax offsets. However, you are liable for the Medicare levy and the Medicare levy surcharge if you don't have Australian private health insurance. You're also taxed on worldwide income, whilst a non-resident is only assessed on Australian sourced income. And for capital gains tax purposes, Australian residents are subject to capital gains tax generally on worldwide assets, whilst a non-resident is typically only assessed on assets that are considered taxable Australian property. So as I mentioned earlier, in the 2021 federal budget, the government announced that it would modernise the individual tax residency provisions. Whilst we are yet to see any draft legislation, the government did mention that the rules would be based on the recommendations that were made by the Board of Taxation, which we've summarised on the following slides. Effectively, the government is introducing a bright line test, whereby if an individual spends 183 days or more in Australia, they will be considered a tax resident of Australia. There is no need for any further consideration on where the individual's family members reside, where their permanent home is, or where their assets are situated. However, if an individual spends less than 183 days, but 45 days or more in Australia, then you need to consider some secondary tests that will take into consideration the individual circumstances. So you can see on this slide where an individual, so we've got the proposed primary test, we've also got the secondary test. So if an individual spends less than 183 days, and that individual is commencing residency, then we need to look at these additional factors. And if that individual satisfies 2 or more of the following factors, then they would be considered a resident of Australia for tax purposes. So the key factors that need to be assessed are, does that individual have a right to reside permanently in Australia? Now that would typically be Australian citizens or Australian permanent residents. Does that individual have Australian accommodation that is available for their use? Now, ownership is not critical under this requirement, but that individual must be able to access that accommodation throughout the year. So this would typically exclude short-term accommodation such as hotels. The third key factor is, does that individual have family in Australia? So that would generally be a spouse or children under the age of 18 that live in Australia on an ongoing basis. And the fourth key test would be economic interests. So does that individual have employment in Australia? Are they carrying on a business in Australia? Or do they have an interest in Australian assets? And depending on the outcome of these tests will determine whether that individual is considered a tax resident of Australia or not. So the other key area of tax residency we wanted to touch on this afternoon is the impact that COVID has had on tax residency in Australia. So as many would be aware on this call, COVID and the continued advancement of technology have enabled more and more flexibility for employees on how, when, and where those employees perform their employment duties. Many organisations are introducing and updating their internal policies, allowing employees not only to work from home, but to work flexibly anywhere in the world. These flexible working arrangements are varying from what we're seeing in the market, from temporary short-term arrangements to longer and more permanent arrangements. So where an organisation does receive a request from an employee to work remotely in another country, it's important that that organisation reviews and considers how this would impact the organisation, including from a corporate perspective, as well as their reporting, withholding, and other social security obligations. It's also important that that organisation understands, does this now create a tax obligation for that company in that other location? So as I mentioned, we are fielding lots and lots of these types of questions. We're seeing more employee-driven requests for a variety of reasons, whether it's to simply visit family that they haven't seen for a while, or a lot of employees wanting to combine personal travel with remote working arrangements. So when an organisation does field this request, it's important that they do their due diligence and understand what the tax obligations may be. And this slide, I'm not going to go through it in too much detail in the interest of time, but it really just steps through some of the key things that an organisation should look at, including residency of the individual, both in Australia and that other location, the implications for the individual, but also the overseas taxes. So is this going to create reporting and withholding obligations for the company, social security, or even a permanent establishment risk for that company in that host location? So that's all I was going to run through today. So I'll now pass back to Stephen, who will make some concluding remarks.
Thanks a lot, Justin, and thanks for all our presenters today. We've only got a couple of minutes left, but I do have just one question, maybe for Tony, just to clarify for me. If someone enters into an agreement which is not a typical employment contract, but under that contract it sort of doesn't have powers to delegate, doesn't have powers for people to deliver results, but they have to act under the supervision of a person, even though it's an ordinary contract for service, do you think that would still be an employee, or would they be a contractor?
The likelihood is that they'll still be regarded as an employee. In that instance, you'd look at the terms of the agreement and see whether or not the characteristics are such that effectively the person's not doing anything independent of the organisation. That is, what they're actually providing is their actual individual labour as compared to providing something by way of an independent service.
Thanks, Tony. Yeah, so we did run 2 polls throughout the presentation. We'll hand out those results later on, but just at a high level, it looks as though at least a third of the people are continuing to have the same level of FBT during COVID. A few have had to increase because they provided more benefits. It's a bit harder for them, and some are doing a bit less. On the employee contractors, just the query about how often do you review it, it was actually quite good to see that 38% of people do it up front, which is really any large employer. I know we have a lot of government people on and large not-for-profits. They should be doing that up front. And it's only 2% who never actually review their contractor employee status, and 18% unsure. This has been an area of a lot of focus of the ATO and superannuation and SRO. So I do encourage those who are not sure to actually go and have a look. So thank you for everyone for attending today's Employment Taxes Update.